Hi, I'm Justin Zacks, Vice President of Strategy at Moonwood Technologies. Welcome back. If you've missed our first webinar with Wellington's Francisco Maeno on investment ideas for 2025, a replay in the app will be available shortly. I'd like to welcome you all to the second webinar of our inaugural 3-day event entitled Navigate Market Volatility with a Resilient Portfolio. There's a lot of uncertainty out there right now, and we've put together a diverse program to help steer your portfolios in the right direction. Each day, we're going to have 3 webinars, each 40 minutes long with a 10-minute break in between. Friday's webinars start at 1 p.m. Eastern and Saturdays at 10 a.m. Eastern. This event is going to give viewers an exclusive opportunity to learn about a variety of topics, including zero DTE options, ETFs, portfolio building, earnings season, U.S. elections, and how to use the Moomo app, along with many, many more. Talking with a number of experts from SIBO, Wellington Management, BNY, and Franklin Templeton, as well as a number of other leading financial professionals. Our second webinar of the day, Advantages of ETF Portfolios in the Current Financial Market, features Matt Camuso, Head of ETF Solutions at BNY Investments. If you want to learn more about ETFs, how they work, and who's involved, you've come to the right place. In the first half of the webinar, Matt is going to deliver a presentation explaining the many benefits of ETFs, along with both how active and passive ETFs are being used. In the second half of the webinar, we'll have a Q&A. So please enter your questions for Matt in the chat right now, and make sure to watch the entire webinar. We'll try to get to as many questions as we can in 40 minutes. If you enjoy the webinar, please check out the live section of the app under the Discover Moo tab to sign up and set a reminder for more of our informative upcoming webinars. Let's dive right in. Welcome, Matt.
Justin, thank you for having me. And hello, everyone. As Justin mentioned, we put together this presentation. We've been doing it really all year long for 2 reasons. One is to just educate more on just the benefits of the ETF wrapper, starting at its core, exactly how ETFs work. I think before we buy anything, to truly understand the mechanics of what we're buying, so here the mechanics of ETFs is critically important. And 2, because we've seen this new wave of ETFs come to market in terms of adoption and product, and that is active ETFs. So what we're going to do today is we're going to cover a number of topics, really starting with, again, the foundation. So understanding ETFs, starting with facts versus misconceptions, the benefits of the ETF vehicle, and then how to truly assess the liquidity of ETFs. We're going to spotlight that new trend I just mentioned, the growth of active ETFs and how they're being used and the different types of active ETFs coming to market. And then we're going to go through a couple best practices that you should all consider when looking to pick the ETF that's right for your portfolio. So to dive right in, we're going to go through the first couple slides pretty quickly here as we have a lot to cover and do want to spend the most of our time on the mechanics portion or the operational portion of ETFs in just a second. But first, let's start with the facts. I like to think about ETFs as a hybrid of a mutual fund and a stock. So a lot of times we see ETFs versus mutual funds or ETF versus stocks. And it's interesting that the ETF actually brings benefits, and we think the best benefits of both different types of products. So for mutual funds, ETFs are the same. They're registered by the 1940 Act, and they're open-ended investment vehicles, which meaning shares can be created or redeemed based on demand. However, like stocks, and unlike mutual funds, ETFs are traded via an exchange. Some misconceptions we often hear in the market are, first, ETFs are only for passive investments. So we say, I use ETFs. Someone immediately just assumes they just use passive or index-based investments. So we just mentioned the new trend here in the ETF industry is the rise of active ETFs. So obviously not true. The ETF itself is just a wrapper, right? You can put any different investment strategy into that wrapper, both active and passive. The second is ETFs are made up of synthetics. They don't actually hold the hard underlying asset, that be it stocks, bonds, or commodities. Again, not true, and we'll get to another benefit of the ETF wrapper in the transparency. You can actually see with 90+% of ETFs in the marketplace, they're daily transparent, meaning that every day you can go to our website and download the holdings and see the actual stocks and bonds that are held within the ETF. And we're going to combine the next two. So inadequate liquidity or liquidity is only dictated by the average daily volume of the ETF. Again, not true. We'll get into the average daily volume metric in a second here, but I want to touch on inadequate liquidity because a lot of the times the specific ETFs that are picked on here are fixed income ETFs, which initially is kind of a natural bias to have towards a fixed income ETF because you have something that's daily traded on an exchange that holds an asset class that is still traded over the counter. However, the counterpoint to that is fixed income ETFs actually add liquidity to the bond market because, again, you're taking something that's traditionally over the counter traded and putting it trading via an exchange matching buyers and sellers. And I think the ETFs industry's best example to counterpoint this, fixed income ETFs bring inadequate liquidity is what we saw during COVID. During the COVID crisis, we had bond markets freeze up and the Fed wanted to inject liquidity into the bond market. Guess which is one way that they did so? They actually bought fixed income ETFs. Again, our best example as an industry of this wrapper can actually add liquidity to certain markets, especially fixed income. Couple of quick benefits. The three we usually talk to investors about are transparency being one. I just mentioned, they don't own stocks or bonds. Well, a good way to debunk that myth, if you will, is just go download the holdings. So unlike mutual funds that usually are monthly or quarterly transparency, ETFs bring daily transparency posted to the issuer's website for any ETF that they issue into the marketplace. This is good to know exactly what you own, but I also love this benefit to help build a comprehensive portfolio. I like to think about putting a portfolio together, a robust asset allocation framework, like you'd put together puzzle pieces. Well, with daily transparency, it's much easier for investors to understand the different ETFs they're blending together if and when there might be overlaps. The second is intraday liquidity. So we just mentioned ETFs like stocks, they trade via an exchange. So from 9:30 to 4 here on the US markets, you can trade an ETF. Unlike mutual funds, you don't have to wait till 4 p.m. to see what that trading price or NAV might be. And last is US tax efficiency. The ETF wrapper, and we're going to go through this in just a second in terms of the mechanics, does bring a more tax efficient way to access an investment strategy. In fact, in kind of the rise of active ETFs, we think is really the tax efficiency benefit. If you look at just last year, there was 46% of active equity mutual funds paid a cap gain in 2023. That's compared to 6% of active equity ETFs. So ETFs can still pay a capital gain. Again, they're just much more efficient. Here's where we're going to get into the real education, how ETFs work. First, we want to take a look at the entire ETF ecosystem. And on this slide, we're going to identify the key players that make this ETF ecosystem really come together. I want to start at the top with the two distinct markets in ETF land. There's the primary market where ETF shares are created and redeemed. And there's the secondary market where ETF shares are traded. If we go to the primary market, so go down one layer on the left-hand side of the page, we have an interaction in the primary market only between the ETF issuer, which is the fund company issuing different ETFs into the market or managing those ETFs, and what's called an authorized participant or an AP. ETF issuer, pretty straightforward. It's, BNY Investments ourselves, we're an ETF issuer. iShares, Spider, Vanguard, these are all ETF issuers. An authorized participant, think of this as a large broker dealer. BNY on our banking side is an authorized participant, but also names like Goldman, JP Morgan, UBS. These are all just big financial institutions that are the only counterparties allowed to participate with the ETF issuer. By name, they are authorized to participate in the creation and redemption of ETF shares. They're also the bridge between the primary market where they interact with the ETF issuer and the secondary market where they interact with market makers and the buyers and sellers. So if we go down to the secondary market, we can see buyer sellers, pretty straightforward, investors like ourselves that interact or buy and sell ETFs on a stock exchange. As an example, the New York Stock Exchange, NASDAQ, CBOE, any exchange here in the US where ETFs are traded. And on that exchange, they interact with what's called a market maker. Again, by naming convention, what these folks do is they make markets and ETFs. So they're providing a bid and an ask on every single ETF that's issued into the US marketplace. So those are our players in the ETF ecosystem. How do they all come together for this very efficient process to make ETFs work every single day? I want to use a very simple example. So we're going to say we have ticker ABC ETF. That's a passive or index ETF that tracks the S&P 500. If we have this ETF in market and it's a brand new ETF, so say it only has $100 million in assets under management and, again, owns the 500 largest securities in the world. Well, if we have a buyer, so let's go through how ETFs are created. If we have a buyer of that ETF or buying interest of $100 million, how does that happen? Because there's only $100 million of shares that are already spoken for out in the marketplace. How could you ever buy 100 million more without moving the market? And this is where the ETF and assessing liquidity really comes to play. Because all we have to do to meet that demand of that buyer for those 100 million shares of ticker ABC ETF that tracks the S&P 500, follow this example with me. That buyer puts that order onto the marketplace. So it hits the New York Stock Exchange. We have a market maker that sees that order. The way the market maker is going to assess if they can actually facilitate that buy order is they're going to look to the underlying holdings. So when they do that, they're going to go look to the 500 most liquid securities almost in the world. And they understand that since ETFs are open-ended, like mutual funds, which we covered a little earlier, they know that they can create more shares of this ETF to meet this demand. So all the market maker knows they have to do is go buy $100 million worth of those 500 stocks, and now follow this orange line with me. The market maker buys that $100 million worth of 500 stocks, delivers them to the authorized participant. The authorized participant notifies the ETF issuer that they have a creation. They transfer those securities into the ETF issuer. The ETF issuer then transfers back that $100 million worth of ABC ETF to the authorized participant, who gives it to the market maker that fills that buy order. Now, the only liquidity parameter that mattered in that execution was the liquidity of those 500 stocks. It was not the liquidity or the AUM of the ETF, because again, ETFs are open-ended. We can create more shares if there's more demand. We can destroy or redeem shares if there's less demand. So we'll go through the same process in reverse. That same investor that holds ticker ABC ETF for $100 million now wants to sell it. Well, not a problem, even though the ETF's now 200 million, they're going to sell half the AUM of the ETF because it still just matters about the liquidity of the underlying holdings. So in that example, this seller is going to come to the market maker sees that order, and they go, okay, you want to sell ticker ABC ETF for 100 million. They take down that trade. They now own 100 million of ticker ABC ETF, but they don't want to hold it. So we follow the blue line. They send those shares of ticker ABC ETF to the authorized participant, who then sends them to the ETF issuer. The ETF issuer then takes in those ABC shares and then transfers back to the authorized participant $100 million worth of those 500 securities. Here's the important tax efficiency point of ETFs. Instead of selling those 500 stocks within ticker ABC ETF to raise that $100 million, we simply transfer out $100 million worth of those 500 stocks in kind. So there's no sale in the ETF. We transfer those 500 stocks in kind back to the authorized participant, who then sells those stocks in the open marketplace to raise that $100 million cash to send back to the market maker to go back to the seller. The important tax efficiency point is because the sale of stock happened outside of the ETF wrapper, it is not a tax consequence or liability for the ETF, ticker ABC ETF, or its remaining shareholders. So the big tax efficiency point of the ETF comes through the redemption process, through the in-kind transfer of securities to meet a redemption rather than the sale of the actual stock inside of the ETF. To quickly move on here, because we do have a lot to cover, I just want to quickly spotlight the growth of active ETFs, because in my career, I've been doing this over 10 years in the ETF industry. I've truly never seen anything like this in terms of the demand, both for new products and the demand we've seen from advisors or investors in terms of assets and active ETFs. So this data, you wouldn't think it'd be too stale if it was at the end of June or middle of the summer, but it's actually pretty stale. So I want to update some of these numbers here live for you. Up at the top, we see 670 billion in assets under management in active ETFs. If I fast forward to 10/31, so month end of October, that number is actually $806 billion now in assets under management, and the number of funds is over 1,500. That's in a few short months. So it really shows the momentum we're seeing for active ETFs. But we put together this slide because I think it's very important when you're trying to decide which active ETF might be right for me, the different flavors of active ETFs that are coming to market. So if we go to this bottom grid here on the slide, the first, and we kind of broke them down by percentage of the total product in market at the time, again, as of June 30. The most popular new ETFs for active ETFs we call standalone ETFs. This is a brand new active strategy coming to market for the first time through the ETF wrapper. The second is an ETF clone. That's 27% of active ETFs in the marketplace. This is interesting because it's just a cloned mutual fund strategy. So same exact mutual fund active strategy, now just brought to market in an ETF version. We then have mutual fund to ETF conversions, pretty straightforward by naming convention. This is a mutual fund actually converting over to an ETF. This has been another popular practice by a lot of asset managers, just taking one strategy from one wrapper to the other to benefit from that tax efficiency that we mentioned. And the last is ETF cousin. Think of ETF cousin similar to an ETF clone, but it's not the exact same active strategy that a manager might run in a mutual fund. It's similar, right? Not directly related, but it's a cousin strategy. So it might have the same portfolio management team, little separate process. A lot of the times you'll see managers do this so that they don't cannibalize an existing strategy. They just bring something similar to it, kind of same attributes, but tweak the strategy just a bit when they bring it to ETF form. Why this is important is if you're looking to buy an active strategy, a lot of investors when doing due diligence want to see track record. Right? Well, if you have an ETF clone or a conversion or even a cousin, and you can relate that strategy's performance to something else that manager does, a brand new ETF launched this week might have a 10-year, 20-year track record history you can leverage if it's, again, a clone, conversion, or a cousin. So always important to ask ETF issuers, is this new active ETF strategy based on something else that you run? We already hit on this, but you just see, again, the growth we've seen in the past, say, 5 years of ETFs, both in terms of assets and product. We've seen almost 400 new products brought to market this year. Record year for flow, almost, I think, let me get my numbers straight here, $225 billion year to date in active ETF flow. Compare that to last year, which was a record year for active ETFs at $123 billion. This trend is not only continuing, it's actually gaining momentum. And finally, before we get to questions, 3 things I always encourage investors to consider when choosing the right ETF to make sure it's the right strategy for them. First is understand the ETF strategy. Going back to what we just talked about. Is this a clone, cousin, or conversion? Because then you're in your due diligence process, making sure you have the most history of that performance or that strategy that's available to you. Tax efficiency, if you're buying an active ETF or any ETF for tax efficiency reasons, you want to understand what the creation and redemption mechanism is of that ETF. In our ecosystem example, we mentioned tax efficiency comes on the redemption side of an ETF transaction. You want to make sure if you're looking for the ultimate tax efficiency, the ETF you're buying does an in-kind creation redemption, because we do have a few ETFs out in the marketplace that still do cash redemptions, which is very similar to a mutual fund, so higher probability of getting a capital gain, or a mix, so cash in lieu of securities plus in kind. ETF issuers will tell you this, but if you're really buying for tax efficiency, what you want to look out for is that they do facilitate in-kind redemptions. And finally, liquidity. What is the liquidity of the ETF? We're not only looking at the average daily volume of the ETF. We want to make sure that we understand what the liquidity of the underlying holdings of the ETF are. Because again, we mentioned that S&P 500 example. Even an ETF with 100 million in AUM, you can trade in extreme multiples of that because of the liquidity of those 500 stocks. Because remember, all we need to do to facilitate a creation or redemption in an ETF is to deliver in the holdings or deliver out the holdings of that ETF. So liquidity, always look to the liquidity of the underlying holdings, not just the liquidity of the ETF itself. Justin, I'll take a pause there. It can be a lot, so we'd love to just wanted to get to questions as soon as we can, because again, we've done this presentation all year and we've been getting good ones. So hopefully that was a good precursor to the discussion, but happy to take questions from you or the audience from here.
Thanks. That was an excellent presentation. We're already getting a number of great questions, and I would just remind our viewers, please continue to type in the chat any questions you have for Matt. We'll try to get to them, and I'll try to break them down a little bit. I did have one question from a user. It was about several different topics, but I want to break them down individually, both liquidity and diversification. But let's start with diversification. ETFs can help investors diversify their portfolios, but how can an investor tell how diversified a particular ETF is?
Sure. So we'll go back to that transparency piece. Go look at the underlying holdings, right? So you can go download off the issuer's website the underlying holdings of that ETF. And when you do that, you're going to see, is it a US large cap ETF where you can relate it to maybe say the S&P 500, right? Well, if that ETF has 10 holdings in it, It's not all that diversified. And a lot of that comes down to whether the ETF is active or passive. You'll see more concentration or less diversifications in active strategies than maybe you might in passive strategies. But I always encourage investors what I like to call lift up the hood of the ETF. Go to the issuer's website, download the holdings, and see what it owns, right? Is it a diverse mix of stocks? If it's index tracking, does it look like the S&P 500? Does it look like the S&P 600 in terms of replication? But that's the benefit of the ETF wrapper, again, when it comes to transparency.
No, that's very informative. And then the other question was liquidity, and you touched a little bit upon this in your presentation, but I just want to go over it again. Maybe you could explain a little bit more about how you define liquidity and then why it's so important.
Yeah, I define liquidity as what is the ability to trade, right? And how much can you trade of something? That's liquidity. And when you're trying to see how much can you trade of something, you're really asking yourself, how much can I trade before I'm going to move that underlying market, right? If I move the underlying market, now I'm starting to influence price, and that's not what I want to do. But again, that's where always look to the underlying holdings. Because an ETF, well, you mentioned ticker ABC ETF is the example. So say it has 100 million in assets, 1,000 shares traded on a daily basis. Understand that ADV metric, average daily volume, is only of the ETF wrapper itself. It's not of the underlying holding. So we like to say the average daily volume of an ETF is what has been traded, not what can be traded. What can be traded is how liquid that underlying basket of stocks or bonds really is. And for that, we do like to look at the volume of the stocks or bonds that the ETF owns to then get a metric you might be comfortable with. Spoiler alert, it's usually a lot more than the average daily volume of the ETF, because again, the average daily volume of the ETF is just showing you how much the ETF itself is traded, not what can be accessed through the underlying holdings.
No, that's a great explanation, and hopefully that'll help some of our viewers understand that liquidity piece. There's just two parts of it, and both of them are just super important to that. And a lot of people think about ETFs and they think about equity index ETFs that track a particular index like the NASDAQ or S&P 500 or something like that. But there's so much more. You talked a little bit about active ETFs. I want to get into that very shortly. But first, a bunch of people in the chat are asking about Bitcoin ETFs. And there's this idea, it doesn't have to necessarily be an equity, right, in an ETF. Can you explain a little bit more, what Bitcoin ETFs are new? What can you tell us a little bit about them? And then a little bit about, ETFs that are not necessarily all equities.
Yeah. So when we do product development, our first step in seeing if a strategy is A, fit for investors, or B, fit for the ETF wrapper, is I sound like a broken record here. What's the liquidity of the underlying, right? So for Bitcoin ETFs, right, liquid market. We finally understand that there's a liquid market out there. There's an exchange. We can put that in an ETF and be confident it can be traded on exchange. On a complete other end of the spectrum, there's been investor interest that we've heard from clients on, can you build me a micro cap EM strategy? No, right? Because I don't want something that's so thinly traded, trading on a US exchange when those markets are closed, because there's not enough depth there. Those underlying names don't trade enough. There's capacity constraints. You don't want to put something like that in an ETF wrapper. That's where you see a lot of these, newer type products, whether they be including derivatives, whether they be fixed income, even emerging market debt. Emerging market debt, you'll look at certain issuance sizes. So in order to be eligible for the ETF, and this is popular in a lot of fixed income ETFs, making sure there's a threshold for the amount of issuance of that certain bond to be eligible for the ETF, because you want to make sure there's a market behind it, right? There's inventory behind it for bonds. There's excess liquidity behind it in terms of equity. So everything we do and everything the industry's done, Bitcoin's a great example, right? We prove that there's a deep enough market there for liquidity that we can put something into the ETF wrapper. We all say, is this ETFable? Bitcoin was a great way to say, yes, it is. And because there's enough liquidity on an exchange. So the liquidity profile is ripe enough to be able to be issued into an ETF to be traded on the US marketplace.
No, that's a great answer. And I see another user bringing up this point that I want to talk a little back to the diversification point. A lot of these things are expensive. Bitcoin's $90,000. If I want to go and replicate a stock market index, it's going to be expensive. Here with ETFs, we're putting all together. If you don't have a lot of funds in your account, this is a great way to diversify. And then on top of that, Mumu allows our users to do fractional shares. And so you can get into these at very low levels of investment. You don't need hundreds of thousands of dollars to start investing. You can get started in investing with much less money, and ETFs can certainly help you do that in a responsible, diversified way. And now I just want to get a little bit more into that active, and just again to remind everyone, active just means that there is a manager. There could be passive where you just track an index and you're going to try to mirror the performance of that index. But with active, there's actually someone behind the scenes pulling the strings. And in the past, mainly we've seen this active part take place in mutual funds, actively managed mutual funds. And so, Matt, I want to ask you, how does this new breed of active ETF, managers, how do they stack up to the actively managed mutual funds?
Yeah, it's a great question. So we'll go back to that different flavors of active ETFs we reviewed, because that's going to vary for the question, right? So new standalone strategies might underperform a mutual fund peer because the new strategy just wasn't designed well enough. But when we look at, to answer the question directly, if you look at an ETF clone of an existing mutual fund, so the exact same strategy, both active, same portfolio management team, same process, same holdings, they perform the same. It's just wrapper of choice. Why us managers are issuing clones of these products is to, like a simple analogy I like to tell people, cup or cone, how do you want your ice cream? ETF or mutual fund, how do you want your active strategy? Right? Let the investor decide what wrapper is right for them, but you'll see very similar performance. You might have some basis point dispersion, basis point meaning very minimal performance dispersions. That's just simply on cash flows over the long term, which you should buy active for. Active investment should be for a long-term strategy, as well as passive. Passive can be a little bit more for tactical use to get a quick exposure to and from something. But you'll see marginal performance in the short term because of cash flows. But a same ETF to mutual fund for an active strategy, it is the same thing. Performance is the same because process is the same. The only difference is wrapper. I want you to synonymize the two. If it's active from the same manager and it's the same strategy, you can think of it as the same thing. Just because it's ETF or mutual fund does not matter. That's just different wrapper.
Right. And the other thing I think a lot of people are still want a little bit more clarity on is this idea of capital gains tax. When you have a mutual fund, you may have to pay, depending on your gains, a capital gains tax. How does, and active ETFs may have capital gains tax, but what's the difference? Why does it differ and how does it differ?
Yeah. So you bring up a great point, Justin. Just wanted to mention that again. ETFs are not immune from paying capital gains. They're just less likely. And why they're less likely is we'll just do a quick comparison of mutual fund and ETF on a redemption. If I have a $100 million redemption in my mutual fund, the process now for mutual funds is they go sell. We'll use that same ticker ABC strategy, so the S&P 500. They go and sell inside the mutual fund $100 million worth of those 500 securities to raise cash to deliver and meet that redemption. So they raise cash inside the fund by selling stocks to raise 100 million to then pay that out to the redeeming investor. That sale of stock, if there is a gain realized when selling those stocks to meet that redemption amount in cash, that gain is now borne by the remaining shareholders because that's now a tax liability for that fund, that mutual fund. In the ETF example, we'll go back to that in-kind redemption. In that same exact scenario, $100 million coming out of those 500 stocks, the ETF will just take $100 million worth of those stocks. They will not sell them. They'll transfer them out to that authorized participant who then sells the stocks outside of the ETF. Therefore, they still raise the same amount in cash. That $100 million in cash was still given to that redeeming investor. But since the sale of stock happened outside of the ETF, it is now not a tax liability for the remaining ETF shareholders. I like to say with ETFs, you can control a lot more your own tax destiny. You still pay a capital gain when selling an ETF. If you buy it at 50 and sell it at 100, you will pay that $50 gain. But you chose to do that. The investor chose to make that sale and realize that gain. They were not influenced by another shareholder in the strategy that decided to sell, forced a gain on the fund, and they got paid out to that investor at year end. You just have more control of your tax destiny with ETFs. Although again, ETFs can still pay capital gains if they do a cash redeem, if they have a big rebalance, if the active manager is buying one stock to, selling another stock to buy a stock more in favor, and there's a gain there. There's ways they can have gain, just again, much less likely because of the in-kind redemption mechanism of ETFs.
Oh, great answer. And, we talked about active ETFs. We talked about Bitcoin ETFs. These are some of the hotter trends. My next question is, other than those two, what are some of these other trending ETFs in both existing ETFs and new ETFs? Where's the money flowing to? What do you think about that?
Yeah, so we've seen a big rise in a category defined by Morningstar as non-traditional equity. And what these are, I call them defined outcome products. So they're usually some sort of derivative-based strategy that might be built to maximize income or maximize downside protection. So using options overlay or different types of derivative strategies put into the ETF for again, defined outcome. So income's been a big focus, low volatility has been a big focus. It's interesting, if you see low volatility passive ETFs, you've seen less interest in those over the past few years, but more interest in these with non-traditional kind of derivative-based outcome ETFs. No surprise because of that. If you look at active ETFs broadly, I mentioned over 1,500 of them in the marketplace. 351, the biggest category of active ETFs, is non-traditional equity, because we're finding unique ways to use derivative strategies, put them in an efficient wrapper like the ETF to deliver investors a certain outcome that they might see fit for their long-term financial goal or a certain macroeconomic environment that might be, again, best suited for that certain strategy.
Great. And then, what the other thing I really want to get into is the risk. There are some risks associated with ETFs, and I do have a few users asking me about leveraged ETFs, which, I've heard can be risky. Maybe you could talk a little bit about the risks you might face from market risk exposure, or, you have the diversification, but there is some market risk. And what about these levered ETFs?
Yeah. So market risk is going to be the same whether you're buying a stock, bond, closed-end fund, mutual fund, ETF. You're exposed to the public markets, right? So there is market risk in ETFs. They don't guard you from that. You do have some execution risk. So I mentioned, average daily volume of an ETF doesn't really matter, or shouldn't, because it has been traded, not what can be traded. But to leverage the underlying holdings, which again we think is the best kind of barometer for ETF liquidity, it's really important of your order type. We always encourage folks to avoid market orders whenever possible, because what a market order does, it just pipes through the exchange electronically to look for the amount of shares you're looking to buy. I love using, even personally, limit orders, right? You're protecting yourself. You're saying, I want to buy this, but this is the maximum price I'm willing to pay. So you do have some execution risk with thinly traded or low average daily volume ETFs. Protect yourself using limit orders. Leverage ETFs, we don't issue any at the time ourselves, so can't speak too in depth on those. What I will say though is, contact the issuer, right? Call somebody, make sure you understand if it's 3x, 2x long, any sort of these buffered ETFs. Make sure, again, daily transparency, know what's in it, lift up the hood, and if you can't explain how the derivative or option works in that ETF, it might not be right for you, right? So making sure you really understand what the underlying are, and don't just buy it by the name because it's a 3x long something. Never buy it by the name. Contact the manager, understand again what's actually made up in that ETF from the holdings perspective.
That's great. And the one last thing I really want to get into that you brought up in your presentation was this idea of net asset value, NAV, and that ETFs can trade either at a premium or a discount to the net asset value of their underlying holdings. Can you provide a little bit more color on this? Do certain types of ETFs tend to trade at big premiums or discounts to NAV? And how long does it last? Is this a few seconds? Is this months you'll see till it comes back in line?
Yeah, so it's a good question. It's interesting. A lot of people say at times they can. ETFs will trade at premiums and discounts every single day, because international ETFs that are listed on the US market, that underlying market is closed for half of our trading day. So that basket of stocks is closed, price is snapped, and the ETF is still trading. So if you get news out of Europe, right, that's positive or negative, the ETF in the US is going to move away from that net asset value. Those premiums and discounts might last, overnight. because once those basket of stocks opens up in Europe, it's going to snap to where the ETF price is. Because the ETF in the US, while that market is closed, is showing buyer seller interest agreeing on a price, a new valuation, because of what happened after the market closed. So that's really what to know is the ETF can be a price discovery tool, especially when underlying markets are closed. In times of market stress, they might last a few days. COVID is another example we use in fixed income. There's a couple articles that came out, right? A fixed income ETF traded a 40% discount. Well, to what? Right. So that, that basket of bonds might not have traded now that we have this new, pandemic, risk being priced in. What's interesting in times of market stress, that's where ETFs again get the nomenclature price discovery tools. Is most times days after a market sell-off, the ETF stays where it's at. So that 40% discount, and you start seeing the NAV of the index or the underlying basket start to come towards the ETF. So it actually collapses to the ETF spread. It can happen again, markets closed, overseas, open in the US, but know that there's arbitrage opportunities for authorized participants. There are counterparties incentivized to keep ETFs in line with their NAV, which would give us all confidence that it might last for a day or two, or sometimes just overnight, but there's counterparties out there incentivized to keep ETFs in line with their net asset value. So for the long-term investor, something to keep an eye on, but not to be overly concerned about.
No, that's a really good point, and investors should always be aware of that underlying liquidity. Is there a big bid-ask spread? When was the last time it traded? Because it can create inefficiencies in the market that are not. It's not the true price of these underlying securities, so the NAV might not line up 100% all the time. I want to thank you so much for being with us today, Matt. It was super informative. We were able to offer our viewers so many great insights. Any last thoughts for our audience?
No, Justin, thank you for having me. I would say keep an eye on the ETF industry. Innovation is happening almost daily. This year we saw Bitcoin, a lot of conversations going into next year about putting private equity or private credit, if we can, again, get some sort of liquidity to that into an ETF wrapper. So innovation of what's ETFable, I think we're just at the beginning. It's an industry to keep an eye on. And again, I just want to thank you and the team for having us. We've really enjoyed this and want to support more questions whenever we can.
Well, thank you so much. I really want to thank everyone else for tuning in. Make sure to check out the special offers on our website if you're not already a Moomoo user. We're going to be back in about 10 minutes with our next webinar, Managing Volatile Markets with Zero DTE, with guest Ed Tom, Senior Director, Derivative Market Intelligence at Cboe Global Markets. Until then, stay tuned for a short video.
Worried a stock's price will go down right after you buy it? With Moomoo, you can check out the most updated short sale analysis before you trade. Find out how much a stock is being shorted and its short sale trend. Get a clearer understanding of the market and trade with greater confidence. Short sale analysis is free and exclusive on Moomoo. Download Moomoo now.
Too much research, too little time? What if you move smart? Invest smarter with Moomoo. Small gains, big efforts. What if you move smart? Invest smarter with Moomoo.
Everyone around me is talking about investing. Do you invest too?
Moo.
There's so much research to do, but so little time. But how do I actually start?
Download Moomoo!
Investing made easier. Download Moomoo now.
Moomoo has partnered with derivatives world leader SIBO, bringing you an options experience like never before. 5 major index options are now available to trade on Moomoo. Enjoy competitive pricing with zero commission, as well as zero contract fees for stock options. Inform your strategies with Moomoo's suite of free options features, including as many as 13 option strategies for you to choose, with their theoretical profit and loss analysis quickly revealed, as well as in-depth options chain, among many others. Experience pro-level tools by downloading Moomoo now.
Hello, Japan.
Hindsight sucks. It's all about foresight. When it comes to trading, you gotta get your calls right. Moomoo's the platform with AI intelligence, serving up insights based on customized relevance. Globally backed round-the-clock support. Pro-level features at a cost of naught. So let me ask you some questions that may seem curly. Would you rather work from dawn or retire early? Dream of getting on the ladder or buy a dream home, dance to someone else's tune? Or Moomoo your own?
Worried a stock's price will go down right after you buy it? With Moomoo, you can check out the most updated short sale analysis before you trade. Find out how much a stock is being shorted and its short sale trend. Get a clearer understanding of the market and trade with greater confidence. Short sale analysis is free and exclusive on Moomoo. Download Moomoo now.
Too much research, too little time? What if you move smart? Invest smarter with Moomoo. Small gains, big efforts. What if you move smart? Invest smarter with Moomoo.
Everyone around me is talking about investing. Do you invest too?
Moo.
There's so much research to do, but so little time. But how do I actually start?
Download Mumu!
Investing made easier. Download Mumu now.
Mumu has partnered with derivatives world leader SIBO, bringing you an options experience like never before. 5 major index options are now available to trade on Mumu. Enjoy competitive pricing with zero commission, as well as zero contract fees for stock options. Inform your strategies with Mumu's suite of free options features, including as many as 13 option strategies for you to choose, with their theoretical profit and loss analysis quickly revealed, as well as in-depth options chain, among many others. Experience pro-level tools by downloading Mumu now.
Hello, Japan.
Hindsight sucks. It's all about foresight. When it comes to trading, you gotta get your calls right. Moomoo's the platform with AI intelligence, serving up insights based on customized relevance. Globally backed round-the-clock support. Pro-level features at a cost of naught. So let me ask you some questions that may seem curly. Would you rather work from dawn or retire early? Dream of getting on the ladder or buy a dream home, dance to someone else's tune? Or Mumu your own?